Trading is about good strategy, trading is about psychology. No. You need both to win in trading. So in this video, what I'm going to be showing you is how to apply strategy, psychology all together to make money in trading. Let's go. So as you can see, I have this template right here, and I categorize this template to three categories, okay? Trading edge being number one, trading plan being number two, and execution being number three. If you are starting to trade, the first thing you need to have, without it, you cannot do it, is a trading edge, okay? Number one, right here, is a trading edge. Why? Without clear trading edge, the probability of trading goes out of the window. Without clear trading edge, you are not trading, you are gambling. What I mean by this? Let's say you go into the markets without no trading edge, right? Let's say you win first trade, you win second trade, you win third trade, but then you lose 10 trades, then you lose 5 trades, then you win, then you lose, then you win, then you lose. So your equity curve will look something like this. No consistent at all, right? And the thing without not having a trading edge is you are not trading probabilities. And trading is all about probabilities. But you are gambling because the probability of the probability aspect of trading you cannot use because if you have clear defined trading edge, let's say from 100 trades, you know you got 60% win rate, right? Sorry for my drawings. You got 60% win rate from 100 trades, 60%. That means you're gonna win 60 trades out of the 100. That is the probability. That's the probability of you winning 60 trades out of the 100, of you winning 120 trades out of 200. If you have no trading edge, there is no probability because you don't know, you don't have data, you don't have anything to prove that your win rate is exactly 60%. The guy who's having the edge and who tested, let's say, 100 examples in backtesting, and he knows his win rate is 60% over the 100 examples, he knows and he goes into the markets every single day knowing, okay, my next 100 trades, my probability is 60%, let's say. I will win 6 out of 10, 12 out of 20. You know, the sample size can be bigger, but you get me. You get the point. Without clear trading edge, the probability doesn't exist. And you cannot get consistent results without doing a consistent action, right? Because this guy number one, who got a trading edge, he's consistent. He's doing consistent things. He's doing consistent things to get consistent results. If you have no edge, that means you are doing random things, you will get random results. Simple as that. So that's the first thing, a trading edge. Without clear, defined trading edge, you cannot succeed long term. You can make money short term, don't get me wrong, but you cannot succeed long term in trading if you don't have a trading edge. That's the step number one. So step number two right now. And that is a trading plan. You need to have clearly defined trading plan how to trade the trading edge, okay? Which means, what asset am I trading? What time am I trading? What session am I trading? Okay? What session? I don't know, what risk am I doing? What risk to reward am I aiming for? That's the trading plan. Entry, stop loss. Okay? That's your trading plan. Excuse me for this, but you get it. Asset, time, session, risk reward, entry, stop loss. That's your trading plan. Again, you need to have a trading plan which you cannot break it. You need to have a trading plan, clearly defined trading plan, how to trade your edge, which means go back one step, which means you start trading, you go into the markets, you learn, let's say, my strategy or somebody else's strategy, whatever, and you go into backtesting and you go and test 100 examples of the strategy. And let's say, okay, I know over the 100 examples I got 60% win rate, and risk reward, let's say I got 1 to 2. 1 to 2 risk reward, which means this strategy works. This strategy is profitable. Okay? Based on the strategy, you need to build trading plan. Okay. I go into the market and I test it on, and I will test it on, I don't know, let's say I will test it on gold. Okay, time, let's say 2 hours a day, 2 hours session, NY session, so on and so forth. Okay? You have these two things. You need these two things combined. Okay? You need these two things combined, because if you then have an edge, and this is your edge probability, but you go into the markets and instead of gold trading Nasdaq or whatever, anything, that edge doesn't exist. It doesn't exist. And again, trading is about probabilities. And the probability aspect of trading goes out of the window again, which means this 60% can be, okay, you say, yeah, I have this edge, it works, but it works on gold. Let's say you go into market and you start to trade silver, and because you test it on gold, which means this win rate will sink to 50%, let's say. You test it NY session, you start to trade London. This win rate sinks to 40%. I'm just using an examples, but without clear trading plan, your trading edge doesn't work. So you need to have trading edge and trading plan based on data which you tested in the past using backtesting tools, whatever. Okay? And the final thing is execution. And that's the hardest part about trading, because that is when emotions comes into play. You know it, I know it, everybody knows it. You have these two things down. You went on a backtesting, you backtested gold, you have over 100 examples, 60% win rate this time, this session, with this risk reward, with this entry method, with this stop loss. Okay? Now, you need to be able to go into the markets every single day and execute these two things without any mistakes. Any errors. And that is when emotions come into play, right? Because let's say you are not thinking in probabilities, which is the most important thing as a trader, and you took 2 losses, okay? You took 2 losses, and you don't think right now in this sample size. Let's say you need to think, that's the main thing. You need to think in a series of trade perspective, not trade by trade basis. Okay, let me draw this little thing, and let's say this is trade number 1 and this is trade number whatever. This is trade number 20, right? And then I will draw this. If you think in a trade by trade perspective, you will say, okay, I took a loss. Okay, I took another loss. Okay, and then your head starts to go wild. You will be scared you will be scared of hopping into trade. You will get FOMO, which means you make a trading error, which means you are no longer again trading this trading edge with these probabilities, because let's say your I don't know, your entry is at key level and you enter way too early because you was scared that you're gonna miss out. That means this probability 60% goes down again because you're probably gonna take a loss. Okay? Then 3 losses in a row. Then you are scared to hop into trade, and guess what? The trade is a winner. Then you are like angry that you didn't took it. You are chasing the markets because you think you missed the setup. Guess what? You enter again too early. Jump the gun. Loss. And then you start to think, okay, 4 losses in a row. Maybe my strategy doesn't work. But that's not a fucking case. Okay? Only these two setups was based on your strategy, and these two setups was based on emotions. Okay? And you took 4 losses, but two of them was completely necessary. Two of them were completely necessary. Okay? Unnecessary, my bad. These are the two normal losses, which every trading edge includes, because you got a 60% win rate over a series of trades. But these two losses were completely unnecessary, and it was a trading errors. Both were trading errors. This was FOMO. This was like, I don't know, jumping the gun. Okay, and that's the main problem with trading mindset, with trading psychology. That is the biggest thing in trading psychology. You need to think in a series of trade basis, not trade by trade basis. Series of trade perspective, because if you are backtesting this, let's say 100 examples of trades, or 20 or 50, whatever. So you need to think in this example. You cannot think in this trade by trade basis. You need to think in this example. Series of trades. Because you cannot know if this exact trade is gonna be a winner or if it's gonna be a loser. You cannot know that. You just know you got a 60% win rate over a series of trades. Okay, so that was guy number A. Let's say guy number B, right now, he's thinking in probabilities, he's thinking in series of trade perspective. He also takes 2 losses. But he knows it's normal because it's how my strategy works, right? But then he doesn't make any psychological mistakes, and guess what? He takes a win. Again, this guy jumped the gun. This guy waited for his setup. Guess what? Took a win. So meanwhile, this guy is minus 4%. This guy is it with 1 to 2 risk reward is plus 2%. And both of them got the same trading edge. Both of them got the same trading strategy. Okay? That is the importance of thinking in probabilities, which means you need to think in a series of trades perspective. Because when you are backtesting your strategy, you are backtesting the series of trades, you are backtesting some sample size, which I said 100, it can be 40, it can be 50, 200, whatever. But then you need to think in that sample size. That will completely eliminate your trading errors, that will completely eliminate your trading mistakes, and you will be able to follow your trading plan. Because you are not fucked up from the loss yesterday, from the 2 losses the 2 days ago. You're not fucked up from that because you know that every trade is unique and anything can happen in the market, and the market and trading is only game of probabilities. You are thinking in a series of trade perspective, not trade by trade basis, and you're gonna make money over the long run, because this guy with his emotions, his equity curve is gonna look something like this. But this guy, his equity curve is gonna look something like this. Okay? And these pullbacks means normal trading losses, which every trading edge trading strategy includes. But over the longer period of time, over the, let's say, 1 month, this guy is going to be up 10%, this guy going to be negative. And only difference between these guys is guy number one thinks in probabilities, guy number two, which means thinks in a series of trades perspective. Guy number two doesn't think in probabilities, which means he thinks in a trade by trade basis.